Okay, today we're going to add a couple more bells and whistles to the capital budgeting problem. We just talked about financial feasibility of individual investments. We learned how to amortize a loan. We made a big deal stating that you can't just look at a profitability of an investment. You also have to look at financial feasibility. You have to look whether it's liquid. We've talked about cases where you yourselves may not have invested in something, not because it wasn't profitable, because simply you didn't have the down payment or you didn't have enough resources to cover any shortfalls in cash, and you didn't want to put yourself in that risky position. Today we're going to talk about discount rates and marginal tax rates. Up till now, we've just basically had them stated in the problem and you've used them. Now let's look at them a little more conceptually as to how to appropriately choose what those are. And that's important, one, because in the real world, those are numbers that you have to come up with. Okay, so we're going to look at conceptually what they are. Although, particularly in the choice of discount rates, some of you may go away a little bit unsatisfied because it depends on you. And I can't give you a precise formula that says that you plug in some numbers and it comes out to be a number. It depends on the situations that you control and you decide what that appropriate discount rate is. However, I will provide some guidelines. The reading assignment for the next section is Chapter 12, and we will talk about controlling farmland. Today, let's talk about the choice of the discount rate. And first, let's look at the theory or a conceptual basis by choosing a discount rate. And given that finance is couched in economics, it shouldn't surprise any of you that we're going to use a marginal concept. We're going to look at the marginal investment rate, and it's an opportunity cost concept. What your opportunity cost is of choosing an investment. The rule then, as we look at it, the discount rate has to be at least as high as your cost of capital. So at least you have a lower bound on the discount rate. Any discount rate lower than that, you wouldn't recover your cost of capital. And that's really not a real hard rocket science here. It's actually pretty simple. If you had an investment of $100 and you borrowed the $100 and the interest rate was 10%, how much interest would you have to pay? $10. No matter what happens, you got to pay that bank $10. So what happens if you choose an investment that only returns 8%? How much do you get? You get $8. But how much do you pay the bank? 10. So what's your loss? Would you ever take on an investment that would return something less than 10% if you had to pay the bank 10% interest? Not intentionally. That's why you pencil out your net present value, right? And you choose a discount rate, and so you would never intentionally choose a project. So you see that the lowest possible discount rate that you would ever choose would be your cost of capital. You would never intentionally choose an investment lower than that. Okay? At least it gives us a lower bound. So at least, on your projects, if you come in with a project and you say my discount rate was 4%, but my interest I'm paying is 8%, then you have done something wrong because you're basically agreeing to work for the bank. Okay, I'm going to go through 4 scenarios, only one of which applies to agriculture, but at least group them into these 4 different types of categories. The one category is where you have access to debt and equity capital. This is what you get into corporate finance, and if you've had a finance course, a beginning finance course in the business school, this is the world that they live in. These are the Microsofts of the world, the General Motors of the world. And if they want debt capital, what do? They issue bonds. If they want equity capital, they issue stock. So they're large enough and they're publicly traded, so it's very easy for them to issue stock or bonds. And it's quite unlimited in how much they can obtain. Another scenario, which is really not very feasible, but there's restraints on equity capital, but no restraints on debt capital. This would be a scenario, and I can't think of any that fit this very well. It'd be a firm that's not a publicly traded stock, but can issue bonds, and can issue pretty much as many bonds as they would want to do. So this would be like the Rabobank, okay, which is a Dutch firm, privately held. They can probably issue bonds out there, but they don't issue stock for the public. The third scenario is restraints on equity and debt capital, and this is the one that we're most likely going to deal with in agriculture, or if you're an entrepreneurial firm, because we're looking at an entrepreneurial firm that isn't publicly traded, so they can't issue as much stock as they want. You know, they may be able to issue stock to family members, but there's a limit of how much money that you can obtain through these types of partnerships or closed family corporations. They're also limited on the debt capital because since they're not publicly traded, they're probably not going to issue bonds, probably not large enough to issue bonds, and the banks are only going to lend so much debt relative to their equity, and since their equity is limited, they're probably limited in how much debt capital they can obtain. The fourth one also is probably hardly worth mentioning. No debt, put money in the savings account, and you know, maybe you have your grandparents fit into that, where they're basically all their money that they have is put into CDs, and that's government secured, and you know, that's, they don't want to hear anything else. But that latter category is really not useful to us, because if that's the case, then they're not looking at investments anyway. Looking at this first one, it's more in the area of corporate finance. We're going to breeze in and out of this. However, if you take a class in the corporate finance, this is where you'll spend a lot more time. And in this particular case, the choice of discount rate looks at the weighted average cost of capital. And of course, that becomes then basically the boundary of the discount rate. You wouldn't accept any investments intentionally that return something less than the weighted average cost of capital. And if we look at the weighted average cost of capital, okay, that is this I subscript A, representing the average, is a function of this cost of debt capital and a function of the cost of equity capital. And they are weighted based on how the assets are financed. Remember from your accounting classes that assets, you have your debt plus your equity. Okay, for every dollar of assets, how are those financed? Well, some of it comes from debt, some comes from equity. And so if we weight these, we weight the cost of debt capital based on the proportion of our assets that comes from debt. So we take debt divided by our assets to get that proportion. And we also weight the cost of equity capital based on the proportion of our assets that are financed from equity. And thus it becomes the weighted cost of capital. In the second scenario, where we have restraints on equity capital but no restraints on debt capital, it's just simply that we could finance with debt as long as the returns were greater than the cost of debt. In other words, if we were looking at an investment that returned 12% and we could borrow at 10%, well, we'd borrow more money up until the point where you didn't have any more investments out there that returned at least 10%, in which case you would stop. And there, that means your discount rate has to be at least as high as the borrowing rate. Whereas in the previous scenario, the first scenario, the corporate finance, the discount rate had to be at least as high as the weighted average cost of capital. In the second scenario, the discount rate has to be at least as high as the borrowing rate. The third scenario, which is more typical of an entrepreneurial firm, which includes production agriculture, and that's where you have restraints on equity and debt capital, then it's simply the yield on alternative investments. In other words, if you have investments out there that promise to return 12%, why would you ever choose something that returned 10%? It's the opportunity cost. Why would you ever go to Texas Tech if you could go to A&M? You could, but why would you ever do that? You know, you're not going to take an inferior position if you've got opportunities out there. That's what the opportunity cost is about. You know, some go to Texas Tech, but that's because they can't get into A&M, right? The fourth scenario, we're not going to dwell on that because it's not realistic if you're looking to invest, and that's where you don't have any debt. You just put in your money in a savings account or CDs, and then it's just your CD rate or your passbook savings rate would be your discount rate. Okay, having given that as just a broad conceptual idea that hopefully rings true, now let's get to the choice of discount rate. As I mentioned at the very beginning, some of you will walk out a little unsatisfied because I'm not going to give you a number. Instead, I'm going to give you this statement right here. The choice of the discount rate is an individual decision. It's your choice. It depends on your alternatives. It depends on, as you'll see in a minute, your level of risk aversion and your perceptions of the future and your perception of what future returns you will get from that investment. It's an individual thing. If you tell me that your discount rate is 14%, how can I tell you it's wrong? I just told you it's individual, right? The only thing that I can say, as I mentioned before, if you say your discount rate is 5% and you then tell me your interest rate is 10%, then I can say, hey, you've missed the conceptual framework. But anything above that, it's an individual choice. But it's an important choice because, as you already know, the choice that you choose for your discount rate is going to drive the net present value, which is our criteria of whether it's a good or a bad investment. So don't misunderstand when I say it's a personal thing that I'm saying it's not important. It's extremely important, but it's something that you have to come up with. Again, conceptually, the discount rate must account for the cost of capital because you want something at least greater than the cost of capital. You also need to account for the return on alternative investments because of the opportunity cost. We also have decided that, at least in this class for now, we're going to also account for risk by adding a risk premium to the discount rate. A risk premium so that we recognize the higher the risk, the higher expected return we need to get from that particular investment to account for that risk. And then finally, we need to include the taxes. If we're going to be using, as we should, after-tax cash flows, then we have to use an after-tax discount rate. You see, I didn't give you a formula there where you could plug in some numbers and come up with it. Just a basic framework that you need to come up with that number. We've been using marginal tax rate, and I've tried to make the case that in capital budgeting, the usual case is we have an existing firm, and we are looking to take on more investments. So when we look at that, we're looking at the added returns and the added expenses and the added taxes, so we're at the margin. So we have to look at the marginal tax rate. And hopefully this little exercise will add a little more clarity to that discussion. Okay, there's two primary taxes. You have the federal income tax, which has a lot of heated discussion. Well, actually it doesn't. I wish it did. On whether that should be a flat tax or a fair tax, or as Barack Obama or the Hillary Clinton group would say, they want to have it the rich paying more taxes than the poor. And we'll see how that's structured in a minute. The other tax is your self-employment tax, which is also taking a little more discussion because the income tax for some people is high, but anybody working has to pay a Social Security or a self-employment tax. And whether if you're working for somebody else, well, they're going to take half of that out of your pocket and your employer is going to put another half in it. Those are fixed whether you're rich or you're poor. They're going to take that money. Okay, incremental cash flows are taxed at one's marginal tax rate. And that's the point that I've been trying to make is if you're looking at an additional investment, there's an incremental cash flow, and those incremental cash flows are going to be taxed at the marginal tax rate. These are the rates for 2007. I could have picked a single, but I chose the more general, the married, that are claiming their taxes jointly. Suppose that you have a business, and suppose that today Okay, without any additional investments, you make $15,650 of taxable income. How much taxes do you pay? You're making $15,650, and your marginal tax rate is what? So you'd pay 10% of that. So you would pay $1,565. That's how much your check to Uncle Sam would be. In these examples where I say depreciation can reduce your taxable income, that's where it comes in, because if you could reduce your taxable income by $100 and you're in this tax bracket, how much money would that save you? So you'd reduce your taxable income by $10, so you'd pay $1,555. Now you can literally see it. Now let's suppose that you take on a new investment, and let's say that the profit on that investment is $100. That means that you're going to make $15,750. $100 more because of this new investment. Now what is your taxes? This is important. Would you take 15% of $15,750? And the answer is no. You would still take 10% of the $15,650, and that incremental amount now that you've added, $100, is taxed at what rate? 15%. So you'd pay another $15, right? That means your total tax burden then would be $1,570. So for that investment, what's your marginal tax rate? That additional $100, what's your marginal tax rate? 15%, not 10%. What's the average tax rate? You would take the $1,570, divide it by the $15,750. It should come out a little above 10%. 10.02. Now in this case, the average rate is 10.02, but what's the margin? 15%. The way things are structured, with the baby boomers coming up through the ranks now, the baby boomers are starting hitting retirement, and it's going to take a very big hit on the Social Security. And since the government's already a deficit, they haven't saved any of that money. Where is the money going to come to pay for all those baby boomer Social Security checks that they've been promised? It's going to come from you. Right now, the Social Security taxes, self-employment, is 15.3%, 12.4% for Social Security, and 2.9% for Medicare. Now, right now, if you make over $97,500, they don't take any more of the Social Security, but they still continue to charge that 2.9% for Medicare. Just so you can see, somebody in a 28% tax bracket that paid 28% in federal income tax and 15.3% in self-employment would basically be paying 43 cents on the dollar.